So really excited to have you here. Would love for you just to sort of introduce yourself, give a bit of a background. You know, I know you have a PhD in physics. You're at McKinsey before this. Like, how did you stumble into crypto?
Yeah.
First off, okay, can you still hear me? No echo, hopefully.
Yeah, perfect.
All right, perfect. So first off, thanks everyone for joining, and thank you for having me and organizing, Jeremy. So as you said, my background is tech. I took sort of a, maybe not unusual in this space, but normally in the business world, unusual route. I was sort of the perennial academic, did a PhD in physics, master's in electrical engineering, master's in physics. Undergrad, I did physics, math, and electrical engineering. Always was on the engineering and physics and math side, and in disciplines where you're always right or wrong. So it was very unique, my first sort of exposure to the business world. I got into trading while I was working on my PhD, got plugged in with sort of the Chicago trading group, got into FX trading, but was introduced to a number of partners, former partners at McKinsey, and that was my first foray sort of into case studies and the part of the world where there isn't always a right or wrong answer. And I was sort of amazed, this was at probably age, I don't know, 25 or something, that I found areas where there isn't a clear right or wrong answer are immensely more interesting. So I ended up joining McKinsey after I finished my PhD, quickly got up to speed on the business strategy ops side of things, which was a really important period of my life for sort of evolving, understanding business, the management side of things that then I use day to day now. Knew I didn't want to advise forever, very much would do the exact same thing if I could go back, but did about 3.5 years there, focused on banking, fintech, asset management, financial services. Spent most of my time actually in San Francisco and New York during those days, but was monitoring different technologies, knowing that I wanted to go build something. So I was looking at the time at crypto, I was looking at VR, AR, and I was looking at 3D printing, and figuring out what I was going to be convicted enough in to want to jump ship and go build something. So I still have strong conviction in those other areas. There's numerous reasons, which maybe we'll get to it or not in this call, and why those are the next add-ons, starting with VR, AR, which is when you link this into what's happening right now with Web3 and blockchain are going to be immensely interesting, followed by the decentralization of manufacturing with 3D printing, but they're just early, and there's a number of infrastructure reasons why those are harder to get to. Ultimately, the signal that I saw that maybe going to crypto was kind of 2015 to 2017 timeframe, the segmentation in the marketplace, looking at different exchanges, realizing that there was different prices between all these things. And again, just thinking from my background in trading and FX trading that, hey, I could pick off pennies between these things. So I became fascinated with just coding up something where I could take off penny in between. So while everyone was getting rich in sort of the 2017 run up, I was like spending massive brain power trying to like make 0.1 cents like between two exchanges, knowing that if I could do that, I could do any strategy I wanted. So ultimately I built some strategies, was running them, they were successful, left in January 2018 to found a firm called Fractal, technically Fractal Wealth LLC, a small market making firm. We got started in arbitrage. Within 6 months, we went into market making. We were on the Coinbases and Binances of the world, and we quickly got sort of the DeFi bug before it was really even called DeFi. I think in early 2019, we had these bright green Fractal sweatshirts. The back said DeFi in all caps, and you would go to crypto conferences, and even at crypto, people are like, what the hell does it mean? Like, what is DEFI on your back? But we were one of the biggest market makers. Most months we were actually the biggest market maker on 0x, which if you're not familiar, it's a protocol that runs directly on the Ethereum blockchain. And that was where we sort of like made our stand. Like I could tell early on, I didn't even know what to call some of this stuff, but the first thing that really sent me down the crazy rabbit hole is when I stumbled across Maker, and I realized that like this was fundamentally different than everything else in crypto. Like I was interested in Bitcoin, I was interested in Ethereum, but there was these things built on top that run in smart contracts and actually have a business model that captivated my imagination, where I could tell that this is the future. So as we got into sort of decentralized market making, we started drinking the Kool-Aid more and more, believing in the ethos, and it seemed obvious that not only would, if blockchains are made to move assets, not only would trading happen in a decentralized fashion, like with 0x and then going forward and Uniswap and SushiSwap and all these other things, but also that there need to be a decentralized market making model. So we were partnering with these different projects, making markets, and we were realizing that liquidity or market making, and if there's questions later on, we'll go to actually define those things if needed, because these can be opaque terms, but these things were like of paramount importance in this ecosystem, because you've actually separated your product and your user with a token, and that means that you live or die by liquidity. So if liquidity just means how whether you're able to get in and out of a token, buy, sell something with minimal slippage or minimal price loss. So we were talking to all these different founders, and they might be building something in the gaming space, but they're spending half their brain power worrying about liquidity, because if protocols and users couldn't access their token without massive losses, they couldn't use their protocol. So that was when we sort of went to the drawing board and said, okay, not only is decentralized market making massive, there also has to be some sort of a decentralized market making model where you're not just making markets on decentralized exchanges. The entire process of this market making trading is actually done in a decentralized fashion. That was sort of the how Tokemak was born. So at its core, we were looking at a market maker and sort of what makes it tick, what makes it work. And the cartoon we drew of a market maker was that there's three things they centralize to be successful. There's capital, there's the executives at the firm that determine what asset classes are going to be traded and where they're going to be traded on what exchanges. And then last, there's the actual trading technology and expertise, which sets the bids and offers in the markets, or the actual orders that people can trade with. We disaggregate all of those things. We said, what would happen if we disintermediated that across the blockchain? And that's how Tokemak was born. So the core of the cartoon of Tokemak is anyone, anywhere across the world can supply tokens as liquidity providers into the Tokemak protocol. The native token of Tokemak, called Toke, T-O-K-E, is what we call liquidity directors as participants. They're sort of the executives of this market making network, which are directing that I want to see ALCX liquidity on SushiSwap, for example. So they're directing wherever the liquidity is needed when it's needed there. And then last, we have something called pricers, which are going to go live later this year, which are only relevant for venues that don't self-price themselves. So Uniswap, SushiSwap price themselves. You need actual market makers to plug into certain venues that do require bids and offers. So that was long-winded. Let me pause there, but that's kind of the background on Tokemak. No. We'll get to membrane later too, I'm sure.
Awesome. No, that was super helpful. So, I mean, just before we dive into, I guess, a bit more of the nitty-gritty on Tokemak, would love for you just to kind of chat to the audience a bit about, why is liquidity so important? Like, why is liquidity to Web3 as bandwidth is to Web2, say, like in this world where, every protocol is going to have a token, and, you're going to have distributed ownership, why do we need this, like, liquidity so much?
Yep. So I don't know a lot in the space. I think a lot of people are feeling that as you go. There's times where you feel like you know everything, and then you realize that the only thing that knows anything anymore are protocols in the space, and all this stuff is ultimately just tokens for machines at the end of the day. I think that's by the way, an overarching thesis I have on DeFi is it's going to get a lot more opaque and confusing to outsiders before, or if it ever gets back more reasonable. And ultimately, this is just going to be like another layer in sort of the internet stack, like TCP, IP, all this other stuff, blockchain. Then you're going to have DeFi. It's a black box to most other participants. Protocols play it out there, and then users are playing in Web3 and GameFi and stuff on top of that. But coming back to sort of this bandwidth question, so we see Tokemak as key infrastructure that supplies liquidity, and rather than seeing it more as a market maker, we actually see it almost as bandwidth. So the analogy is in Web2, it was all about data, storing data, moving data around, and so the flow of data can be measured in bandwidth. So much like if you're in the mid-90s and you're with a dial-up internet, you couldn't imagine things like cloud-based gaming or streaming video, Netflix, et cetera, because you just didn't have the maybe you could imagine them, but you were ahead of the curve, and you just didn't have sort of the bandwidth or the flow of value in the system to do, or flow of data in the system in order to do things useful like that. Web3 just replaced data with tokens, and that's basically the equivalent. So now you have tokens moving around. So in a world where tokens or value are flowing around instead of data, liquidity plays the role of bandwidth, because again, it's how quickly you can move from one token to another, translate back and forth. And that's why we believe that liquidity is bandwidth in the space, and you essentially need this utility that spreads across everything and is willing to buy, sell at the best possible prices from all users, letting them get in and out of trades. It's not even really trades. This is less important for traders and investors, more important for protocols and individuals, users coming in and out of these things, using access tokens, going in NFTs, doing all these things, going into gaming. It's going to unlock absolutely crazy things that are going to seem like probably 1 or 2 orders of magnitude more insane from today than if you're at 95 thinking about Netflix. So.
Yeah. Okay. So if before Tokemak came along, if I'm a protocol, like let's call this protocol Jeremy, and I want to issue a token called Jeremy Coin. Before Tokemak existed, I'd have to basically, create a liquidity pool on Uniswap or SushiSwap, and basically start deploying equal part Jeremy coin, equal part Ethereum or whatever to basically create that trading pool. And then obviously that's not going to be enough, because I'm going to have to build that pool just to make sure enough people, there's enough liquidity in there. So I'm going to have to give a lot of incentives, and these incentives are naturally super inflationary. So first of all, I guess, why is that a problem, and why is that unsustainable? Just like paint that picture for the audience, and then maybe just sort of show how Tokemak slots into that.
Yep, absolutely. So I'll say there was two solutions, overgeneralizing here, but sort of two buckets of solutions before Tokemak. So one is, as you were describing, there's one that was earlier, which was to work with central market makers. And all this stuff I'm going to be kind of painting in black and white here, and the space is very gray. Like right now, as Tokemak's still running up, you should still work with market makers. Market makers, including centralized ones, are not evil or bad guys. I'm just going to be showing you the inefficiencies sort of in this model. So centralized market makers, their general model was they got inventory of the tokens from founders. Sometimes they also took payments, sometimes call options, all these different various ways for them to be incentivized and over-incentivized often for their labors. They then would make markets on centralized exchanges. Kind of was your only option if it was a centralized exchange, was to use a centralized market maker. In the early days, that was sort of Fractal's model too, is even when we went into with my first trading firm, even when the decentralized trading happened, it was still a centralized firm making markets on these decentralized venues. Then came along the Uniswaps and SushiSwaps, all of these so-called AMMs that exist in a decentralized fashion. And they realized there's a different way. Because if you think about this in the early days, might not seem like it now when it's quite easy for most of these protocols to raise, at least over the last year or two. But traditionally, it was these protocols were token rich, cash poor. And so there's this other model, which was once you have an AMM that prices itself, you could just supply your own token, and usually have a ton of those. In the treasury, in the DAO, they would have enough, they could supply those. So then it became, okay, well, we still need to supply the other side, which is ETH or USDC, as you said. And if anyone for those of you on the call that have used Uniswap or SushiSwap, and importantly, if you act as what's called the LP or the liquidity provider, you have to put both sides in. Now, there's been advancements with Uniswap version 3 where it doesn't have to be 50-50, but fundamentally, all these things make you come kind of from both sides. I can compare contrast with Tokemak, or I can kind of let you keep running down the current line of questioning, unless you want me to jump that direction now.
No, jump to Tokemak, because I think this is what I think is so kind of beautiful about the Tokemak model, right? The single-sided liquidity.
Yep. So with Tokemak, what we realized was it's a pretty darn advanced user. I might not feel like it because I'm so in the trenches day to day, and this is my life, and I might not have a life outside of that. So it seems like a simple thing for those of us that know how to provide liquidity to SushiSwap or Uniswap, but it really isn't. One, you have to go through quite a few tabs in order to just find it. You already need to be Web3 savvy, and then importantly, you need to have both sides. So let's say that you're a believer in the Alchemix protocol, you have ALCX. Well, if you want to provide liquidity to help, again, this liquidity bandwidth of the project, well, now I also need, maybe I have $200,000 of ALCX, but now I also need $200,000 of USDC or ETH. Very capital efficient. And it doesn't make sense that the individuals have to be sort of hamstrung in that way, where each individual, each end has to have that 50-50. Tokemak basically abstracted things up a level. So it said, give us whatever you have. We don't care what you have. If you have SNX, if you have ALCX, if you have Wi-Fi, if you have Illuvium, whatever you have, hand it to us. You don't need the other side. Meanwhile, we have other reactors. We call these single-sided deposits reactors. It's all sort of focused around these fusion reactors or Tokemaks, which was what I did in the past. Whatever you have, put them in. We'll, on the other side, source the Ethereum and all the different stable coins. So the DAI and the Frax and the Fei and all those things, USDC. And then we'll flow those or the ETH together. So we'll let the liquidity directors tell us where to go. And our system of smart contracts will pull the 50-50 or otherwise pool to then deploy down into Uniswap. So you can kind of think of it's higher on the stack. You had to have the exchanges in order for this layer to exist. No trades go through us. A trader always goes to Uniswap or SushiSwap or Balancer or Curve. But above that, where's a sort of market maker puppeteering liquidity into them, coordinating the deployments of these things and making it so now users don't have to have both. You can give us in perfect sort of capital efficiency, whatever you have, and we'll deploy those kind of crowdsourcing on both ends. And
so with kind of single-sided liquidity, where does, how does that mitigate impermanent loss, for example? And maybe just describe what impermanent loss is, and then, chat a bit about that. And maybe also would love for you to touch on how kind of like Uniswap v3 sort of concentrated liquidity pools affect impermanent loss and things like that as well.
Yep. So impermanent loss is this, you'll see it everywhere. As for those of you that might not be super far down the rabbit hole now, if you start going deep into DeFi and Web3, you're going to see IL referred to everywhere, and IL means impermanent loss. If any of you are from traditional finance or trading, this would be just known as being a market maker most other places. It's sort of the concept of what's often called getting run over. So if a market maker stands on the bid and offer, so you have like order books if you've been on Coinbase or FTX, where you have offers up here, the level at which a market maker is willing to sell, bids down here, the level at which a market maker is willing to buy, and the difference between them is called the spread. When the market goes up, it's always from a trader, which is often also called a taker in the space, but a trader comes and starts buying from the offer, which then lifts up the order book, or they sell to the bid, which decreases the order book and the price moves down. If you think about that, every single time that happens, it's going against the market maker. So the market maker is the one sitting up here saying, I'm going to sell, someone's buying. So the price is moving up and they're selling in an upward moving market. So locally, they're sort of always wrong in a sense. But what market makers make their money on is mean reversion, sort of about the middle of that spread. IL is that concept. So if the fact that in SushiSwap or Uniswap, the LPs, these liquidity providers, are the market makers, it's the same concept, but just in a different form. As the market moves up, you're basically selling the thing that's going up in price, and so you're underwater, and that's called impermanent loss. Now, it's more nuanced because it has to do with like the quantity difference, and it's a piece of that they call the IL, but that's the fundamental approach. Now, in coming to kind of back to higher level concepts, if I lost you there, don't worry about it. It just means that there's these losses you experience as a user if you provide liquidity just going directly into SushiSwap or Uniswap. It's improved from a capital efficiency perspective and sort of more, I'll call it levers to control those parameters with Uniswap v3 and some other things that are coming out, but it's sort of at a crux there. Or in a crux, that's what it is. And on the Tokemak side, what happens is we've built up higher or above this, and we enable people to come in on one side, and we have a different pool. Right now we're using the DAO Treasury, but we're about to scale into a whole different group of assets, which is coming out over the next couple of months, which manages all the IL. So the user, they get back something called a T asset. If any of you have interacted with Aave, for example, the lending protocol, they give you back an A asset. On Tokemak, you get back a T asset. But instead of standing up a money market or a lend-borrow market like an Aave, here you're supporting liquidity where people can buy and sell from it. But importantly, you always have one-to-one. If you put 1,000 ILV tokens in, you get 1,000 TILV tokens back. And there's a totally different tranche or bucket of tokens that's used for all of that IL messiness, or sort of the slush fund where it goes up and down. And that's sort of slowly pushed away so that entry-level users don't have to worry about it. They never have to worry about these losses. They can just put it in there. Their tokens are utilized, they earn, and they don't have that impermanent loss or IL risk.
Amazing. That's actually really helpful. And so with I guess with sort of where Tokemak is at now, how many sort of reactors have been spun up? What's the process for that? Is this sort of centralized governance? Is it the toke kind of holders who all vote on which reactors get spun up, etc.?
Yeah, absolutely. Do you want me to should I share my screen, or do you want me to go verbally?
No, share your screen. Yeah, go for it.
Okay, awesome. Let me share this. Okay, let me know if you can see here.
Yeah, perfect.
Okay, great. So this is tokemak.xyz. This is the protocol. It shows here how much TVL is in the system. So right now there's just under 1.3 billion in total value locked, or TVL, on the platform. That's how much is sitting in the smart contracts. Scrolling down to your point, this is this concept of these different reactors that we use. So we have what's called the pair reactors. These are where the ETH and the stable coins. So for any of you that aren't in the space, this might look like total gibberish, but these are all sort of proxies for the US dollar, various stable coins and algorithmic stable coins, Frax, UST, USDC, and so on. There's a couple wild cards in here, like Geom, for any of you that were 3-3 in it. Now we're in the past with Olympus. That's just another store of value. It doesn't necessarily track the US dollar. Fei, all these different assets. These things are then paired with what we call the token reactors. These are the governance tokens. So right now, I think there's 9 of these live. So FXS, Alchemix, Sushi, Tracer, Fox, AP Wine, SNX, Gamma. Illuvium is about to go live. The only reason that one hasn't gone live yet was they were doing an upgrade, I believe, to their token. And we're going to be having at least 5 more reactors soon. So we're going to have another voting event. The token holders basically have governance, or are able to hold, able to basically determine which new reactors go live in an event called Core, Collateralization of Reactors events. So if you look over here, this shows Basically, it's here's like 30-ish different projects. You tell us which one should get liquidity, and they vote them to the top of the stack. So this is just kind of showing how the last event ran all the way through to the ones towards the bottom, and we'll be doing another event like that soon. Eventually, that's going to become permissionless, where it's not an actual event where we're going to sort of have discrete votes, but rather anyone can put forward, much like on SushiSwap or Uniswap, drop a token hash in, and should enough liquidity be provided and token be staked to it, the reactor will be spun up and live. Let me pause there, and I think I only answered half your question, so you can restate if I can hit the other side.
Yeah, so with the sort of single-sided liquidity pools, how are you attracting equal amounts of sort of, both sides of the asset pair?
Good question. So the short answer is at the moment, it's not perfectly balanced. We're about to fold in one more sort of mapping within our equation. So there's equations, I won't bring up the functional form, but they're available in one of our Medium articles on how all these APRs are controlled. So there's basically a, I'll call it greed maximalization equation that's used on the back end to sort of see where the different APR should go. So the concept being, as long as users are maximally greedy, where with their token, they're always going to whichever. So like right now, some token should flow over here to these two reactors where they can get 50% APR, from these where they're getting 48% and 47%. And that makes the system, we basically mapped so that the system was providing peak efficiency or peak liquidity efficiency if people were maximally greedy. It's never, of course, perfect, and there's other reasons that people want to be using that, but that was sort of the thesis. So down here, you asked about the matching. These reactors have something called Pro Mode, where if you click on this, you can use your token that's staked here to control where this FXS goes. So there's $158 million in FXS, which is Frax shares, the governance token on the Frax protocol, or algo stablecoin. And you see here, there's this quick mapping. So every one token, the vote from every one token is directing $510 of liquidity, and they can direct where that liquidity goes sort of across the space. By default, it deploys it into Curve. It's first sort of bootstrapping its own liquidity for these T assets, but you can see where the other votes have gone. So about 2 million is routed to Uniswap, 3 million routed to SushiSwap. Over the next month or two, we're going to change these defaults so that even when people aren't active voting, we still have more of a kind of a split across all these different venues. And there'll be a lot more we're going to be adding across DeFi, both Ethereum and outside of Ethereum in the future. Coming back to your question on sort of if they're not balanced, there's an extra term or factor we're going to be adding in the equations of how these APRs go that will make it more close to balance. In the meantime, anytime if you have too much on the pair side up here, which would be the case right now, I believe, or extra on the others, we have sort of other deployments we can do. For example, Curve. Stables can always be deployed into Curve single-sided, so you can always take the overflow there. And then now that we've deployed some of these governance tokens into Curve, we can actually deploy those as well, which historically haven't been on Curve, because now we have pools where you have two different variants or derivatives of FXS deployed in the same pool. Same kind of thing down here for ALCX. There's a ALCX key ALCX pool.
Yeah, Carson, while we're actually chatting about Curve, I think this is probably a good time to just maybe like zoom out a little bit and actually just chat about the Curve wars, like where Tokemak is playing in this, where Convex is playing in this, and just maybe, give a bit of an overview of, what the Curve wars are and why it's so important to the future of DeFi.
Yep. So the Curve wars, even to insiders, I think is one of the most like opaque things in the system. I actually built Tokemak not paying attention. I mean, I knew how to use Curve and why it was very important, but I wasn't paying attention really to the Curve wars until sort of after the core of this was built. And then I realized that there was some really interesting analogies. We're doing something very different and non-competitive, but there's things that are sort of analogous mapped between what's called the Curve wars and what we think is going to start heating up, in some ways already has, with the Token wars and where we think this is going. Curve wars is really all about, so a quick primer, Curve is basically like a Uniswap or SushiSwap, so an exchange, but it's always for like. So in the beginning, that was stable coins. It was things like DAI, USDC, USDT, all stable coins based on the US dollar that should basically hold a one-to-one peg. And so the slippage or the movement from exchange rate of 1.0 is much, much tighter, and they have a different sort of curve mechanism, versus hence the name Curve, versus Uniswap or SushiSwap, where you're trading something like SNX against ETH. You can do that not just for stable coins, but you can also do that for other things that are like for like. So different variants of ETH, different variants of Bitcoin, hence where I was going with the T assets here for what we're using on Tokemak. But at its core, the core users right now of Curve that care about the governance token called CRV were largely stable coins. And the reason was they were controlling the emissions. The CRV governance token allows you to control the emissions or the new supply of CRV that's released and how it's basically paid out to the different liquidity pools on Curve. And so early on, some algorithmic stablecoins groups got very smart and realized, we can actually we can hold our peg at first to sort of reinforce whatever mechanisms they've done just on the back end within their own smart contracts to hold to $1. If we peg it to something that's $1, like a USDC, maybe a centralized stable coin like a USD coin that from Circle. And so they started using that to then incentivize these liquidity pools, which then attracts everyone to put their liquidity in and becomes a sort of self-fulfilling prophecy to hold the peg. Now, as you took that through to its logical conclusion, you got really giga-brained algo stable coins, including Frax, and there's a number of others, but that was one that really was ahead of the curve in understanding Curve and realizing they could actually use that as basically the core approach to sort of holding the peg. So if you got half of that, the main thing is the Curve wars were centered around providing stability for stablecoins. So because if you think about what you need to have a successful algo stablecoin, first thing first, it should hold the peg to whatever the thing is that it should hold. Most of these are trying to hold the peg to the US dollar. Convex, actually, let me first go to the sort of analogy with Tokemak, then I'm going to come back to Convex. The next thing that stablecoins need after they do that, like it's not enough to say that you're a successful stablecoin if you hold the peg. You also need people to use it, care about it, trade it, hold it. And if everyone's just dumping their liquidity into Curve, it sort of defeats the purpose. You held the peg, but now no one's using it anywhere. And if there's no trades going through Curve, sort of no one cares. So phase 2 of all this becomes actually adoption and usage and pairing across all of DeFi. And that's where Tokemak comes in. So if you use Toka, again, I'll try not to go too deep into the weeds on this, but Toka can be used somewhat analogously to the CRV, where you can use Toka to control the emissions. Back when I was showing you the site, you saw you could stake to those different reactors. That juices the APR for liquidity in certain pools, and therefore groups can use that. And additionally, down in that pro mode, they can use it to pair with their stable coins. So sort of phase 2, after groups can sort of say, aha, we can claim victory on holding our peg. Now what? Now we need people to actually use our stable coin and gain adoption across DeFi. They'll go to Toka in order to make sure that they actually get liquidity and pairing in these things. So that's kind of phase 2. Now, you mentioned Convex, and this is good for any of you on the, I'm not sure if the group's I'm sure we have some insane gigabrain power users here, and then probably some that are just getting into DeFi. So we're getting into some pretty deep concepts here. So Convex is something that was built on top of Curve, and it had this immensely interesting, I'll just try to simplify it as sort of a leverage of the governance power. They sort of figured out that they could separate out the earning potential and the governance potential of the CRV token, because it usually had both. You could basically do the staking, you could lock it up over a time period to both control where the emission goes, earn, and then, but importantly, be using this governance thing to control the sort of flow of emissions. They pulled those two things apart, tranched it into like kind of two different groups, and then were able to, in a really intelligent manner, give sort of leverage, and you get to these things called bribes, but basically they can tranche out and say, okay, you're going to use this to control the emissions, and separate that out from people that just care about the earning or the APR potential. And so that ended up meaning that now it actually made way more sense for groups to sort of fight to control CBX as sort of the new spice or whatever, as opposed to just the CRV. Now, there's reasons that they generally do both, and that gets into probably too close to the weeds, but the point was it was this higher governance protocol, really intelligently crafted, that made then Convex sort of the belle of the ball. Tokemak, interestingly, even though we don't use the VE model, even though pretty soon we're going to have something that's actually, I would argue, more intuitive and more interesting than that, with the reserve mechanics that I was talking about a little bit before. We have something where we're a little bit like Curve and Convex combined, but for general liquidity and adoption, as opposed to holding stability. And sort of, you can think of like Curve is sort of locked with, you're controlling emissions, but you're confined to the playing field of Curve. Tokemak is sort of free to go anywhere in DeFi across any of these venues, and you can control the emissions and therefore the liquidity across all these things.
Amazing. No, that I'm really glad we kind of went to the weeds a little bit there. I think that was really useful. So where do you see Tokemak in 5 years? You know, where does this how does this story play out?
Yeah. So ultimately, going back to that kind of concept of, or that analogy of liquidity bandwidth, like the goal with Tokemak is to get spreads as close to zero as possible. Like the price should be the price. We want, in a limit of this, the goal is to have all assets be provided as liquidity. So if you take a big step back from the ecosystem, if you're active as either a user or you make some angel investments, or you just are a degen and you do stuff throughout the space, you'll probably realize that a crazy amount of tokens are locked up. And while that helps early on, just from various sort of ecosystem and sell pressure approaches, it doesn't help in that you have all these tokens that could be used doing something useful, and they're just locked in a staking contract, basically as paperweights. The goal with Tokemak is to actually get it so that you can flood the ecosystem with liquidity. So the price is the price, high, low, whatever it is. Use all of these tokens, whether they're in a protocol, staking contract, anything. They should hold T assets, or in the future something called P assets. They'll give you a little bit of alpha here, but basically be provided as liquidity bandwidth so that people can easily move in and out of assets. Protocols, people-facing protocols, but importantly, protocols-facing protocols can interact with Tokemak. Eventually, I think that not a lot of people are actually using our site. It's just happening in the back end between contracts, but that's sort of the end goal. This thing's really infrastructure or utility that's out there. And I think everything that's coming with Web3, my current thesis is that gaming is the biggest industry on the planet within 5 years, 10 years for sure, but with it probably within 5 years, because you have like just an insane amount of things happening right now where you have competitive gaming meets Web3 meets NFTs, meets like all these things are kind of AI intersecting with that. Forever, I was not an AI maximalist, and man, I've seen some absolutely insane stuff over the last year that makes me hyper bullish now. How all this stuff's coming together. But anyways, all of that's going to be built on top of basically this decentralized economy, of which Tokemak is one key critical infrastructure piece here for liquidity. Of course, you have other things with exchanges, lending protocols. You know, I think there'll be 10 to 100 of these DeFi protocols that 80% of transactions are always interacting with, but no one knows or really cares that they're there. Just like probably if most of you gigabrains at Stanford right now, if I asked you to explain every layer of the internet, you probably couldn't, nor probably should you. You should be higher up building applications and really cool things. Same kind of thing with DeFi and with Tokemak. And in the limit, we call that the singularity. So the goal is eventually to have the system not require third-party liquidity providers. The protocol itself just owns enough liquidity to be the mammoth liquidity provider sort of across the entire ecosystem. And we call that moment the singularity. You'll never really approach it fundamentally because the space will keep expanding. I think we're on a limitless horizon right now for the first time. So human economics have played out on the surface of the earth, and now we have a virtual world with almost limitless experiences to get humans excited about. So I think that we'll always be chasing that, but that's what we're heading towards.
I think that actually really neatly segues into so this next topic, which is always fun, I suppose, with sort of just this multi-chain future, right? You mentioned gaming. You know, a lot of games are built on like Ronin, whatever it is, like a purpose-built blockchain, whether that's on Solana, Ronin, or Ethereum, or an L2 or something like that. Is there a world where Tokemak essentially provides cross-chain liquidity? And I suppose that. What would be the pain points there? You guys would need like proper bridges, right? That was secure, scalable, and that you could direct superfluid liquidity across the entire sort of ecosystem.
Yep, that's exactly right. So the good news is there's a lot of really great teams right now building both token and data bridging solutions between these things. So we have sort of the benefit of right now we're trying to make sure we get everything right on Ethereum and then some select L2s that we're going to, but the future is cross-chain. At least to some degree, and the future of Tokemak is definitely cross-chain. The goal is to be in any protocol. Users and protocols should be able to give us their single-sided assets wherever they are on whatever chain. We should accept them anywhere, and we should let our liquidity directors route that liquidity to wherever it's needed throughout the ecosystem to whatever protocol on whatever chain it is, same or other. So that's definitely where it's all going. I think we have the benefit right now of we're going to be going to Matic fairly shortly, as well as, and then I think Arbitrum. I'll have to look back at the roadmap, but we'll have a number of things that will be rolling out over the next several months. And then over the next year, I think as these bridging solutions expand, we'll be able to do that. Now, there's sort of two different layers. There's one where it's the protocols interact, and then there's another where cross-chain doesn't always have to go through a chain or a bridging solution necessarily. And later, if we get time to it, that's sort of a good segue to membrane, which is really, really helpful for retail traders and importantly, institutions and trading desk people from traditional finance. So if we shepherd them into the new world, sort of, that's where membrane can come in, which is also inherently cross-chain, but in a different way, a different, unique way that actually has much less friction.
Would love to actually dive into membrane. Just one more question on that. How, like, where is do you always see the access point as being an ERC20 on Toka, or does it really not matter where the access point is in this kind of cross-chain world? Like, you could just come in on Arbitrum and you could exit on, like, you know, Solana, whatever it is.
Yep, and when you say access point, are you saying if you enter with
I'm thinking
on the liquidity provider or liquidity director side?
Liquidity provider side. I'm thinking, like, you know, as an individual user.
Yep. Yeah, it'll be any to any. So that's what we mean on the first any. So you should be able to provide liquidity any on anywhere, including at any other chain. And then the liquidity director should be able to direct that liquidity anywhere that pool of tokens is supported, even if that's a totally different chain. So yep, that's definitely where it's going. We won't be limited to ERC20 on Ethereum. Yep.
Amazing. Would love to, before we open up to the audience for a bit of Q&A, would love to just hear a bit more about membrane as well. I'm sure folks are really interested in that.
Yeah, absolutely. So I'll give you the short answer or the short overview on this, and there'll be a lot more that we can talk about in the very near future, because membrane is about to be rolled out. And if there ends up being appetite and opportunity, would be more than happy to come back and do one dedicated on membrane sometime in the future as well. So at its core, so linking back to Fractal, because I think I kind of told the story there and then talked about how we saw the need to build Tokemak. Also saw the need to build membrane starting in late 2018, early 2019, was looking to launch a fund, was down the road in that direction. Glad, by the way, I didn't, because Tokemak and membrane were born, but was going that direction and realized that even if I launched the fund and I'd already burned a lot of money on attorneys and stuff, all of my strategies weren't going to work, because everything operated as what's called pre-funded spot, but basically buzzwords for you had to have your funds at Coinbase, at Binance, et cetera, in order to actually do the trades. I couldn't have them at a qualified custodian, which, since it would have been a US-based fund, that would be where I had to hold them. So like at a BitGo Prime or BitGo or something like that, or Anchorage. So came back to people that I knew and respected from traditional finance and said, hey, you know what I don't think exists here is, and many of you probably won't be familiar with this term, but is like a clearing infrastructure, which in traditional finance enables something called prime services. So and that's kind of how membrane was born. So at its core, and in a minute I'll make this much more tangible, at its core, membrane is a clearing, netting, and settlement platform. You can think of clearing as everything that happens sort of, I'm going to oversimplify things here and probably not do the formal definition, but everything that happens after you would do a trade. So institutions usually don't do what people are used to right now in DeFi. In DeFi, everyone's used to execution and settlement happening at the exact same time, because as soon as I agree to a trade, the agreement is actually us changing funds. And in traditional markets, it'd be Jeremy and I agree that I'm going to buy 100 BTC from him, or 50,000 shares of Apple, and then we settle sometime later. It might be T+2, which means we delay, or 2 days later, I give him the shares, or I take the shares and give him the cash, et cetera. There's some reasons why within crypto, they started sort of with collapsing all of that to a single point in time. It's a very interesting model, but it also doesn't scale very well. And you're seeing obviously a lot of scaling. You know, scaling is a whole other can of worms that we could get into. As institutions come into the space, and retail, but active people that are trading, lending, et cetera, there's a lot of times when you don't immediately want to settle as soon as you execute. So what membrane does is it allows you to do OTC trades, so peer-to-peer trades. So I could be looking at Jeremy, or Genesis could be facing Alameda, do some sort of a trade, can trade all day sort of on paper between each other, either on balance or credit, where I have to see that you have balance, or I just could say, Jeremy's a good guy, I trust him, he has $10 million of credit with me. We can also do lending, and then later on we do what's called netting. So we basically look and we turn every single thing we did into debits and credits. Then we line everything up into tables based on the assets. So we see everything that you did that touched Bitcoin, everything you did that touched ETH, everything you did that touched all the ERC20s, net it down to a final single number per asset. And then we basically give you one settlement instruction for each. So you can actually net things down 99% or more for active participants in the space. So imagine what that can do. Even this isn't usually sort of the pitch for membrane, but going back to probably things that that the blockchain club might dig into, this can really help with congestion on a lot of these different networks. If groups that are actively trading back and forth, maybe in Telegram all day, rather than saying hit it every time and then they're sending and they're paying It's expensive. It leads to more transactions. Now all of a sudden you might be doing one for every 20 transactions you're actually doing. So Membrane will enable users to build basically subnets. So you're going to have retail subnets built on it. You're going to have institutional subnets built on it. And subnets just meaning that it's a peer-to-peer double opt-in process. So I could say, yep, I know Jeremy, I'm going to trade with him, but then Jeremy also has to approve me to go in. Similarly, the different desks can do that. And there'll be linkages between retail and institutions. But it's going to be very interesting. I'm super excited for the rollouts coming over the next couple months here. And you're going to be able to drop any ERC20 token hash in to basically trade any ERC20. And you can do cross-chain. So you're going to be able to do any ERC20 on Ethereum in exchange for Bitcoin, Litecoin, Bitcoin Cash. We're adding support for Solana, any EVM-compatible L2s. And inherently, this just kind of works because you're trading on paper. You don't actually have to even wait for the bridging solutions, but you're cross-chain because it's in peer-to-peer networks where you then coordinate the final settlement. And importantly, at the very end, we queue up the payloads to whatever wallet you have. So if you have a Ledger, and then we're about to add MetaMask, Fireblocks, and then we'll go on down the list for self-custody wallets as well as third-party custodians. We basically wait until both counterparties sign. So if like I owe you 10 BTC and you owe me 50 ETH or whatever, if you sign and I'm like out to lunch or whatever, and I'm not going to sign for several hours later, even though you've signed, we don't broadcast it to the blockchain right away. So we wait until both sides sign, then we sort of lift the floodgates and everything's synchronized, which removes what's called the Herstat risk or the settlement risk in the system. So if it all sounds a little more institutional, it's because that was the first signal, but I'm super excited about, we sort of already know how retail is going to use this. And I actually think it's going to be really change how a lot of people do, especially on the trading side on the retail. And then the lending, I think you can open up to brand new. We can do over, under, or uncollateralized loans through it as well. It's going to be pretty revolutionary. There's also going to be a token called Brain that's going to be used as a credit market that basically can back different individuals on the desk, and it will lead to sort of a credit market parimutuel, where different desks will earn different APR, and you're sort of inverting the credit market. So rather than banks assigning AAA, AA, et cetera, on down, now the degens are assigning credit ratings based on an implied APR. So it might be like, this desk is earning 8% APR, so the perceived risk is pretty low. Carson Trading is earning a 400% APR because no one knows who Carson is. And there'll be interesting opportunities there.
And how are you going to come up with those kind of credit scores? Are you going to kind of like, is it going to be a DeFi credit score oracle that you guys create, or are you going to use sort of third-party sort of credit oracles? How are you thinking of that?
Yeah, so it's interesting. It actually literally bootstraps based on the risk that the participants want to take. So all that will be on there. So let's say that you had Alameda and you have Genesis as different desks, and then you also have Liquidity Wizard, my name on Twitter, like all these different participants. They'll be on there as well with information about how much activity we've done trading lending over the last periods in Membrane, and if we've ever defaulted, meaning if we ever didn't click send, because no one can force someone to click settle at the end. And then it will say, based on our activity, that determines how much gets paid out to the pool. So if I'm a super active user, I'll naturally attract a bigger pool, because 70% of the fees that I generate being on the platform is going to be paid out to that pool. Now, that pool, as it gets paid out, is going to attract different size capital, because you'll take the amount paid out to it, then work through the implied APR, and that will determine the denominator or the size of the pool. So the free market basically just figures out how much APR to assign. And so if someone ends up defaulting, and this thing ends up being the backstop, probably too much detail for this on this call, but it would queue up basically a trade to make the other counterparty whole. But then again, it would just be like, okay, who's the name? What's their past? How much trading volumes do they do? Okay, they defaulted once over the last 3 months, and it will just adjust the APR in real time. So it goes beyond these discrete credit scores into sort of real time, real space credit scores.
Interesting. And I guess, these subnets are basically just, they can be de facto permissioned pools, right? Where the KYC AML questions are taken care of, you reduce counterparty risk, so you can actually get some real volume on the institutional side very quickly. Amazing.
Yep, that's exactly right. So it's a really interesting one where, like, I don't know if I'm more excited on the institutional side or the retail side. It's going to be big on both. But yeah, the fact that on the permission side, you can have it. And I think it's also going to be a great conduit for getting more capital into DeFi, because I think there's a lot that are trying to get in. And this will enable them to be like, hey, custody however you want. We're not going to tell you how to custody. Trade wherever you want, because we're agnostic on the execution side. You can trade directly through us, or you can go via API, and we'll add integrations to other exchanges, integrations to different OTC aggregators, et cetera. So execute wherever. We just want to own the clearing, netting, and settlement, make it easy for you to map those. We're sort of agnostic, sitting in between letting all users make their own choices.
Amazing. Well, I'd love to open this up to the audience. And so if anyone has a question, just feel free to raise your hand, come off mute, and fire away. Yeah, Michael, go for it.
Hey, Carson, thanks so much for coming today. On that note, I'm curious what you see as like the beachhead sources of liquidity, especially on the peer-to-peer side. Like, how are you planning on getting people comfortable with those types of evaluations they'll have to make in evaluating risk, and especially as you think about going beyond people who are very literate in this space, because that's where I think a lot of the capital will come from.
Yep, great question. So I think two different sort of ends that we're going to be like attacking this from with Membrane. So this was first built from sort of a desk, or what you'd normally call like institutional point of view, even though in DeFi and crypto, some of the things that are considered institutions are act much closer to retail. But on the one side, we built it so we didn't introduce smart contracts prematurely, because a lot of those desks, if their institutions are facing each other, they don't want or need an extra layer of sort of escrow, or something that's just going to be a bloated contract they interact with. That means extra fees. So everything's really cheap. Basically, everything goes down, and it's just going to be two different transactions going both ways. It's crazy how much you'll save in sort of trading fees going through something like this. So on that side, we will get adoption because these different institutions will plug into each other, and they're already doing business with each other. And I've been inside on some of the biggest desks, and they're the ones that have absolutely insane amounts of business. You would not believe that they have basically zero. For being in the tech industry, most of these centralized desks have zero tech on the back end, and they're running everything basically through Google Sheets. It's horrifying, and I feel bad for their ops people. They have a good process in place, don't get me wrong, just meaning it's horribly inefficient. Not, I would say, horribly risky, but it is horribly inefficient, and their ops team are just slammed at a lot of these desks. So we're building a consortium actually right now of those players, so that we know sort of day one we'll have that kind of desk buy-in and start building kind of from that side of things for the subnets. And additionally, with these Brain tokens, I don't know if I got much into the emissions, but as you trade and lend more, you're going to be earning more of the Brain tokens, which you can then stake to earn the fees of the system. So we're taking the page out of the DeFi side of things in this sort of CDeFi protocol that is Membrane, to make sure that we're paying users, incentivizing them to users. So that's from that side. On the other side, because getting to sort of the double-edged sword here, we want to make sure that as less informed, and in some cases uninformed retail enters, that they're still safe on the system. So the way we're planning to do it is, unless you, we're going to have sort of a couple different user types, and unless you do something extra, and we're defining right now what extra is, you'll probably only be able to trade in our safe pools. Safe pools mean that we can do things as batch transactions, which means we can actually fully remove the Hurst at risk. So sure, maybe your counterparty might have found you on, like, you might have seen someone's call to arms on Twitter that they're trying to buy 50,000 looks with FNC or something like that, and so some crazy thing, and they're like, add me, and we'll just both double opt in and say we're KYC'd and we're good to go. But at least then if someone goes in and it's like a scam artist, they might have a busted trade, but they're probably not doing downstream trades from that anyway. Busted trades are something that matters more for big institutions, but they're at least not going to send any funds without receiving. So we can do it as a batch transaction that either both goes through or both fails. So that's super important, because I mentioned why I'm super excited on the retail side. Right now, we're building in some of those mechanisms to make sure that, like, there's also enough protections in place that those that are uninformed that and come in don't have any issues dealing with this thing that's sort of institutional ready when they're not quite ready for it yet. Good question.
Hey, Carson, thanks so much for being here. One question I wanted to go back to what you hit on earlier a little bit, was you talked about how you sort of tranched out the impermanent loss risk with the with what sort of providing single-sided liquidity. So is that something where, is that like a separate investable product, and you're just providing a lower APR and sort of taking the higher risk portion and letting people bear that risk separately? Whereas right now, as a liquidity provider in Uniswap, I have to sort of take that whole risk as a package.
Yes, that's correct. And I'll give you, this might be one level more detailed than you're looking for, but it's a good question, so you probably want this. So we're going to be launching something called P assets. The distinction here being T assets, which were originally for Tokemak, but it really contributes to our TVL. If you think about a TVL in the space, is effectively just loans, right? For a long time, everyone was like, oh, they're basing valuations on like loans that can be pulled out at any point in the system. The V model or vote escrow model, which I didn't go into detail on this, but the Curve kind of Convex model, which is gaining traction and is interesting and good, but it's got a lot of sort of, you're sort of like taking two discrete endpoints, locking forever and keeping liquid and making this big blurred area in between with this vote escrow model. We're going to be taking it all the way to the full conclusion, saying you can have T assets where you can put them in and you can redeem them when you want, or you can have P assets, which sort of stand for permanent assets, or things that contribute to our PCV, our protocol controlled value or protocol controlled assets. Those are ones that are sort of thrown through the singularity or whatever and handed to Tokemak that they own free and clear. Now, why would anyone do that? So this is very much coming back to, if you're familiar with Convex at all, this is sort of like CVX CRV. So Convex, again, what you can do it with leverage effects, and we have the same thing, and this is what I'm super excited. This is what I've been like heads down on, working this out along with Membrane on the Tokemak side, is figuring out exactly how to get this flywheel going. But you're going to be able to put it in, mint this other one. There's going to be a secondary market. So even though you can never sort of pull it back one for one, you can go through a Curve pool and trade around kind of 1.0 to get out. And that pool, since you've contributed it and you're not allowed to sort of get it back, that one can slosh up and down. So that's the one, and it really is the protocol itself, but the protocol itself is the one that's buying as the market goes down, selling as the market goes up, being sort of the grand market maker at scale, and it's all handled through those P assets. So again, might be more than you were looking for, but that sort of tells you, yes, long-winded way of saying yes, and those P assets are going to have higher interest rate because they're going to have interesting things like some revenue share and stuff that goes in there, and some other things that make them even more attractive than holding the T assets. But it'll be two different options that users have, and that'll be coming in the next couple of months here. Right now, only the T assets are live.
Carson, thanks for being here. I'm wondering about how what your viewpoint is on the energy used currently, generally speaking, throughout the industry, and who do you think the players are that are doing things the right way regarding energy use?
So it's a good question. First I'll say just sort of general state of the system, and then I'll say kind of high level on players. Interesting thing is probably on players, other than people doing some interesting things sort of on the mining via sustainables and things like that. I don't know as much because I'm usually right now at the application layer more on the ones where I like know all the different projects as opposed to some of the base layers. And I think there are some base layers doing really interesting things there. So I would say across the space here, there's definitely like a double-edged sword to the space, right? Where there is a good amount of energy utilization. And I think that's something that will improve drastically over time, just like any technology. At first, there's going to be inefficiencies with it and problems with it. I think one of the things that often people don't sort of take into account in their full sort of calculus of what the impact is what they're comparing to. So I actually often compare this to like Manhattan and London is what I think of it as. So at its core, we're sort of, and it's actually much bigger than that, but where the right sort of comparison is the things we're disintermediating. And effectively, if you look at, I mentioned kind of before this analogy of like a new and limitless economy that's going to be built out as opposed to what's played out. If you look at how much the financial centers consume right now with massive skyscrapers full of bankers doing very inefficient tasks, and now we can do things in the blockchain, you'll actually, I'll try to find something and send it over because there's a really interesting analysis on this, but it ends up being that if you do sort of an interesting comparison in what it can disintermediate, even in its current form, it's probably a big savings. Now, that's of course sort of pie in the sky, right? Because we're not immediately going to turn those things off. And also then it's like, well, what do those bankers do? We're not just trying to put people out of work without having something else productive for them to do. But there is sort of this interesting sort of on economics approach. Now, I think as more of this, as things went from proof of work, proof of staking, I think that was a step up. I've admittedly been so far down the sort of Ethereum Solana rabbit hole lately that I'm probably not like the best one to say on sort of what state of the art is on sort of the L1 frontier for these different things. But I know there's a lot of different groups that are exploring that. And I think it's something that's definitely needed in the space because we have to be able to do all the democratization of finance things that's possible here, but also make sure that it's sustainable and it isn't worse for the environment.
Can you, one more added question, can you speak to Avalabs, how they're doing with that? Are you familiar with how they're managing it?
Yeah, I am. So on the environmental side of things, I don't know. I definitely don't think it's worse than any of the other ones. I think I'll try to dig in on that one a little bit. I know Avalanche from a pure utilization standpoint and cost has been very strong, I would say, so far. And I think probably has an edge on this dimension as well, probably compared to some things, including Ethereum. I think Ethereum, right, is in badly need of scaling solutions. Now, the good news is there's like 10 different things, probably at least three of which look very promising. And maybe those things can cut down on the economic footprint of Ethereum. But I think Avalanche is making inroads there as well.
Awesome. We probably have time for one more. Jeff, do you wanna go?
Yeah. Hi, thanks again, Carson. I had just a really broad question about NFT liquidity and where you think.
I was going to ask that. I'm so glad you asked that, Jeff. Okay, great.
Yeah. Yeah. Okay. So just a broad one about. Oh, sorry. Go ahead.
Yeah, super where you think how methods for providing liquidity around NFTs and where good developments within that space.
Yep. So it's definitely something we're thinking about both on the Tokemak and the membrane side. Tokemak in terms of providing liquidity. I was sort of fascinated by this from the beginning. I probably did a lot of thinking about this like 9 months ago, and then we've had so many different things that we've been digging into on both Tokemak and membrane side. I haven't thought as recently, but the crux of it is the issue with NFTs, at least if you're unless you're in a collection where there's N of them and they're all basically if you look at Aletheia ALI token, and there are different pods that they have right now, which is a very interesting artificial intelligence project if you haven't looked into it. So they have some things where it's more or less the same. So there you could actually do some things where you could actually have the asset, start seeing what people bid and sell, bid and offer on it. But for things that are truly one of one, like if someone wanted liquidity for Bored Ape number 432 or something like that, we've been thinking about how you could potentially still have sort of a reactor for unique non-fungibles that are one of one, where you effectively see how much token gets staked to it, knowing that if someone provides it and sells and it actually sells, the token is going to be on the hook. So it effectively is, there's this weird factor of two. This is me rambling a little bit, but you basically are seeing how much someone's willing to just actually get access to the liquidity in the first place. Then also what they're pricing, and the pricing has a different way you can plug in, but there's a way you can basically link into it. So you're paying a liquidity penalty because it's only one for one. So how much do you even want them to come to auction? Do you want to pay for them to come to auction in the first place? And then how much additionally are you going to pay them once they actually showed up to the auction, so to speak, and said that and are willing to look and potentially sell their product. So that's sort of on the Tokemak side. On the membrane side, just in terms of trading these things, right now we have any ERC20 support, so you can drop in a token hash and it just pops up whatever asset. We're going to add ERC 721 and probably others in the future, and that will be a really interesting way where you can do OTC trading for NFTs. You could even do it cross-chain, so someone with Bitcoin could come in and buy a CryptoPunk or something like that. So.
Cool. Thank you. What was the project again you mentioned at the start?
Alia?
Oh yeah, just at the start of my question or answer, sorry.
Yeah, it was
yeah. It's I'm probably say it's either Aletheia or Aletheia, ALETHEA.AI, and the token, if you look it up, is ALI, which stands for Aletheia Artificial Liquidity Intelligence. It's one of the most insane projects I've seen out there right now. It's merging deep and in some cases unsettling GPT-3 AI that you can actually own as an NFT pod. And the goal of it later is you can actually make your NFTs. There's actually already a line of them where they've done this. I own one of them. You can go and talk to the NFTs right now. So you'll be able to actually own AIs, then set them to different tasks in the future. And then the ALI token will be used to basically for this market to make people go and do your yield farming with the AI, or go respond like Siri on the different things. So now you can actually, and you can customize the things. You can go change their voices, change their personalities. It's crazy. If you want to see kind of the future and then say look kind of to see why I'm saying, if you look at that plus what's happening with GameFi and gaming and all the stuff that's built on the higher layers above DeFi, it's going to be absolutely insane. You all are in the right spot at the right time if you're all at Stanford and in school and paying attention to this stuff. The next 5-10 years are going to be awesome. So.
Carson, thank you so much for taking the time to come in today. Really, really enjoyed this session. Loved how much kind of detail we were able to go into, and can't wait to have you on again to chat Membrane whenever you're ready.
Yeah, absolutely.
Carson.
Well, really appreciate everyone